Welcome back to A to Z Equities, where we cover all US listed stocks from A to Z. Today we're covering AllianceBernstein, ticker AB. We're going to be rating this company from 1 to 5 stars in 5 different metrics: industry, price, growth, financial position, and management. At the conclusion of the video, we'll give a blended, averaged 1 to 5 star rating to this company based on the averages of its scores in those 5 categories. So without further ado, let's get started, beginning with industry. Let's go to AB's investor relations page and see what this company does. Investing in AB. Explore AB's distinct investment proposition, combining differentiated investment performance with robust distribution capabilities to drive sustained organic growth that's among the investment industry's best in class. So that's a lot of corporate speak. Not too much information on what they do. Clearly, they are an investment company of some sort. Let's go over to Wikipedia and get a better idea of what AllianceBernstein does. So we see that AllianceBernstein is a global asset management firm providing investment management and research services worldwide to institutional, high net worth, and retail investors. So they're an asset management firm and they provide both asset management as well as research services to institutions, to wealthy individuals, and to retail investors. Now, this is a really good industry to be in. The reason being that it's very high margins. This company doesn't need to go out there and build plants, manufacture a product, do a lot of advertising, ink supplier agreements. This is a more self contained industry where presumably the company's reputation is a big part of where it gets its clients from. They may do some advertising, they may have that sort of expense. Clearly, they would have salary expenses, office expenses, software expenses, things like that. But generally speaking, this is a high margin industry. The expenses should be relatively low relative to the money they're making. And that's really good. That's really attractive as an investor. They're kind of spinning money out of thin air in the sense that their revenue is going to be coming from fees that they charge for managing assets and research and the like. So that's really good. We're going to give them 3.5 stars for industry. They're off to a solid start. Let's move over to price. And as always, the first thing we want to see is what is the company's price, right? So that means what is the company's market cap? The market cap is $3.77 billion. That means that if you multiplied this $33.02 share price by the total number of shares outstanding, you would get this figure, 3.77 billion. That is the total value of all shares outstanding for this company. So, now that we know what the price is, let's compare it to the company's financial results. We see here that there's no revenue number listed at the top of the income statement, and that's likely because the revenue is essentially the same as this figure here, EBT, earnings before taxes. Again, this is something that you might expect to see for a business like an asset manager, where, again, the money that's coming in is basically the fees that they're charging, the expenses that go into that. I don't know if there's a bigger revenue number than this one. Which expenses are coming out of, I couldn't tell you. Based on this, it looks like the EBT is basically all the money that's coming in. That's earnings before taxes that accrue to investors. That's what it looks like. So then we see there's a little bit of an income tax expense, and then we have net income. So we're not going to do a price to sales ratio for this company. We don't have a revenue figure. And if we use this EBT number as the revenue figure, we would get a very high price to sales ratio, which wouldn't really be fair if the gross margins are 100%. So let's skip to the price to earnings ratio. And we have 326.9 million. Let's round that to 327 million in net income. Moving over to our calculator. So we're going to divide our price, which again is 3.77 billion. We're going to divide that by 327 million. And we get a price to earnings ratio of 11.53. Very decent, nice price to earnings ratio, pretty low, and they're off to a good start on the price front. Now, moving on to the cash flow statement, let's see what the company's free cash flows look like. And we see that there is no total levered free cash flow, unlevered free cash flow number listed here, right? Usually we would expect to see those total figures for the whole company as well as per share. Here we only have the per share number. That's not a problem because we know what the share price is, right? And just as if we multiplied the share price by the total number of shares, we would get the market cap. So, too, if we multiply the free cash flow by the total number of shares, we would get the total free cash flow. So, the free cash flow per share is 276 and the share price is 3302 currently. So, 3302 is our price, 276 is our free cash flow, and we get a price to free cash flow ratio of 12. So that's a really good price to free cash flow ratio. So we're low on the price to earnings, we're low on the price to free cash flow. Looking good so far. Let's just see how the price compares to assets on the balance sheet. So we see 2 billion, 2.1 billion in total assets, no liabilities whatsoever. We have zero point 0.6 million of total liabilities. That's nothing. So we have total equity, total book value of $2.085 billion, $2,085,000,000. So if we divide our market cap of 3.77 billion by 2.085 billion, then we get a price to book ratio of 1.8, looking very solid. 1.8 is definitely on the lower side among publicly traded companies. 1.8 price to book ratio, looking very solid. Let's see about the tangible book value. Same number, 2.085 billion. So we have a price to book and price to tangible book ratio of 1.8 each, looking very good on the price front. AllianceBernstein is going to get 4.5 stars for price. Again, very low price to earnings ratio, just over 10. Very low price to free cash flow ratio, also just over 10. Price to book and price to tangible book values of 1.8. These are all low, good, solid value numbers. And on the price front, AllianceBernstein gets a monster 4.5 score. Moving on to growth, let's see how the company has done on that front. Moving back to the income statement, so let's see how this EBT, these earnings before tax, have done over time. And we see there's definitely a clear growth trend. Over the last decade, it's gone from 210 million to 363 million. That's a very nice jump. Now, along the way, there's been some choppiness, as we see. Went up to 239, down to 232, up to 270, a little down a little, up, way up, and then down again. So 2021 was the peak year for this company in terms of both EBT and earnings. However, that was really an aberration of a year. And on a trailing 12-month basis, that would be the second most they've ever made in a year, it looks like. So, overall, putting 2021 aside, I would say that there's a pretty solid growth trajectory here. Not perfect, but pretty solid. And then we see the net income also very solid from a decade ago when it was at 186. Now it's at 327. So very solid growth. And again, choppiness along the way. 2021 was the peak year, but this would be the second most in the trailing 12-month period. So both on a long-term basis as well as on a short-term basis, right now, recently, we're seeing very solid growth. Now, let's move over to the cash flow statement and see how they're doing there in terms of growth. And we see that here the growth is not as strong. Definitely a lot higher than a decade ago, but not the kind of like 70% growth that we saw with the revenue and net earnings over the last decade, and also choppier, right? The past year is not as impressive here. 2021 and 2022 were both very impressive. Here we're back to 2020 levels, 2018. Nonetheless, pretty solid over the long run. The free cash flow growth is a little bit of a mixed bag in terms of, on the one hand, definitely over the long run, there's been growth, but in the short run, that hasn't been the case. So, lastly, let's see analyst estimates. And I will caution that in this case, with a company like this, presumably their earnings have a lot to do with how much money they're returning for their clients. Fees tend to be higher when investment returns are strong. So, with that in mind, we're going to take these estimates with a huge grain of salt, but here they are. Analysts expect double digit growth this year and next before slowing in 2026. On the revenue front, that growth is expected to be a lot slower. 1.3% growth this year, 5.5 next year, 8.4 in 2026. Overall, solid growth in the long run. On the revenue front and earnings front, we're also seeing that in the short run. On the cash flow front, not as much. Overall, we're seeing pretty solid growth here, so we're going to give them 3.5 stars for growth. Now, turning to financial position, let's go over to the company's balance sheet. And we already got a bit of a sense of this because we saw this company has zero debt and basically no liabilities. So they're going to have a very strong balance sheet. They don't carry any cash, nothing like that. Everything is long term investments. And these are not their clients' assets. These are the company owned assets of 2.1 billion, all in long term investments and growing over time. That's their total assets. They have no liabilities. This is one of the strongest balance sheets you could possibly imagine. None of the metrics that we usually look at are even applicable here. We can't compare earnings to debt or earnings to interest. There is no debt. There is no interest. There's no current ratio. There are no current assets. There are no current liabilities. It's all long term investments. And I think this goes to the fact that this company really doesn't have real expenses like we saw. Pretty much a dollar in accrues to shareholders. That's really good. They don't have any need to carry cash. They don't have any need. They don't have accounts payable, accounts receivable. This is just long term investments. Everything that they have, they're investing for their shareholders, putting some of their money where their mouth is, if you think about it, because they're really advising clients and managing money for clients. And here they are taking their own money, meaning their shareholders' money, investing some of that as well. And putting their money where their mouth is, I suppose. So this balance sheet is about as strong as it could get in a way. And we're going to have to give them 5 stars for balance sheet because, again, no debt, no liabilities, over 2 billion in assets invested for the long term. That all looks amazing. So 5 stars for financial position. Lastly, moving on to management, and we'll start by looking at the history of earnings surprise, meaning has this company beaten or fallen short of estimates in previous quarters? Wow. So we see here earnings per share beat 8 times out of 8 in the last 2 years. Revenue beat 8 times out of 8 in the last 2 years. That is a perfect track record over the last 2 years of beating analyst expectations, under promising, over delivering, managing expectations well, communicating to the market less than they're actually going to accomplish. Love to see it. Let's move over to insider transactions. We see here 30,000 shares have been acquired by insiders in the last 6 months, 13,000 sold. If we scroll down, we see that these acquisitions were actually stock awards, so they don't really count. There's a little bit of selling, 12,700 shares, let's say 13,000, and then you multiply that by $32, $33 share price. Uh, Really not too much selling, less than $500,000 of insider selling in the last 6 months for a company that is worth close to $4 billion. So, not too bad, not too much of an impact. It doesn't really say anything about what management thinks about this company. It's not like there's mass selling going on. I would say this looks pretty neutral in terms of the insider activity. Now, we're also going to want to see if the company is buying back shares, if it's paying a dividend. So we see here that there isn't any buyback activity. They've actually, in past years, they've issued some new shares year after year, a little bit, tiny little fractional issuance of shares. In the over the past year and a half, it looks like they haven't done any of that, and they really slowed down since 2019. They've really slowed down on that little bit of share issuance that was going on before. We see they do dedicate a lot of cash to paying dividends, so let's just see here. Seeking Alpha will tell us what the dividend rate is. And we see, wow, the dividend yield on this company is 8.64%. They're basically paying out everything. I mean, somehow we saw on their balance sheet their assets keep going up, but they're just paying out tons to shareholders as a dividend. And look, I'm not a dividend investor, right? In the sense that I don't think a stock is better just because it pays a dividend. When a company pays a dividend, all they're doing is they are deducting money that's on their balance sheet. They're taking it off their balance sheet. They're giving it to the investor. Now, that's great. But in theory, it has no impact on your total returns because if the company's holding it on its balance sheet, it's also a shareholder asset. And then when it's given to shareholders, it's no longer on the balance sheet. And so basically, it's just been transferred from the company account, which the shareholders are the beneficial owners of, into the shareholder accounts, which they're also the beneficial owners of. So I'm not a dividend seeking investor. But on the other hand, when a company is paying out this much to its shareholders, you know that the management team is not playing games. They're not holding on to your cash. They're not reinvesting it at poor rates of return. They don't see something good to do with it. They take it and they give it back to you. And that is great. You love to see that. It factors in terms of the management team because you see the management team is not trying to aggrandize themselves. They're not trying to build up their company and just accumulate assets. If they don't have something to do with the money, which clearly they don't need to reinvest for the future. We see what their balance sheet looks like. Any assets that they have there are just in long-term investments. So they're just going to take some of that money, most of that money it looks like, and just shovel it back to shareholders. Love to see it. So again, they're destroying on the earnings surprises, right? Every quarter, they're beating on revenue, they're beating on earnings per share. On the insider transactions, again, pretty neutral there. Not really issuing shares, not buying back shares. That's also pretty neutral. And then they're paying a fat dividend, which shows that they care about shareholders. They don't have anything good to do with your money, so they give it to you. Love to see it. On the management front, we're going to give AllianceBernstein 4 stars out of 5. So again, on industry, AllianceBernstein got 3.5 stars. On price, 4.5 stars. On growth, 3.5 stars. Financial position, 5 stars. Management, 4 stars. The average rating for AllianceBernstein, 4.1 stars. Ding, 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 ding. We have a new number one stock in the brief history of this channel. Best rating of any company. Our first 4+ star stock, AllianceBernstein, ticker AB. This is not financial advice. No buy or sell recommendation is being made here, but this research may indicate that it's worth looking into further if this sounds like an interesting investing opportunity. All of that said, thank you so much for tuning in to A to Z Equities. If you enjoyed this video, if it was educational or informative, please feel free to like and subscribe. And we're hoping to see you back on another A to Z Equities video in the near future.